level. At the same time, she will also help us understand where is the Indian economy headed in the new year 2025. A warm welcome to you, Aditi. We also have with us Sugandha Sachdeva, the founder of SS Wealth Street, who will now be sharing with us an outlook on commodities and currencies. That's gold, silver, rupee, and even a bit of Bitcoin is what we will understand. And we also have Mr. Sudhir Bandyopadhyay. He is the group chairman of IndiTrade Capital, to share with us an outlook on the stock markets and where should you be investing your money in 2025 for great returns. Warm welcome to all of you. Season's greetings, and thank you so much for taking the time out. Aditi, I'm going to start off with you. Tell us what is really impacting growth in India, and more importantly, will this be a continued risk of further slowdown in the new year?
Thank you, Sakshi. Well, we do think that the Q2 print was probably the trough, and now we expect that growth prints are going to look better in Q3 and Q4. Specifically, there were a lot of transient factors that did have an impact on the pace of growth in Q1 and Q2. Between the elections, the heat wave in Q1 and excess rainfall in Q2, some of these factors of course are behind us now, and so we don't expect that disruption going ahead. We have our ICRA Business Activity Monitor, which is a compendium of 16 high-frequency indicators, and that's showing us that the pace of volume growth has improved in October-November as compared to Q2. So that is one of the reasons that we're hopeful that the growth trends are going to look better. Also, we are awaiting more data, but there is a lot of headroom for government capex to grow in the second half of the year. And if that comes through, then that certainly will be a supportive factor to growth. Rural demand should also be more steady now. That we have a reasonable kharif output, rabi sowing is on track, and reservoir levels are fairly healthy in most of the regions. So this is another reason why we feel that H2 growth will pick up. Overall, we are looking at a GDP growth of 6.5% each in FY25 and in FY26.
Okay, got that. In fact, we also spoke to Mr. Neelkanth Mishra. He's the chief economist at Axis Bank, and he also shared his outlook on the growth in FY26. Let's listen in to what he had to say.
We expect that as the year progresses, we should see a steady improvement in the economic momentum, and FY26 should be closer to 7% real growth.
All right. In fact, now let me just go across to Mr. Sudhir Bandyopadhyay. I'm coming to you next, sir, to understand a little bit more detail. Tell us what are the big learnings that investors should take from 2024, and what is the outlook on 2025? Will we continue to have another year of strong growth, or will we have to temper down our expectations?
Look, there are a lot of things which have happened over the last 3-4 months, which have led to a certain amount of realism coming back to the market. One is, of course, there has been massive withdrawal from Indian markets by the foreign institutional investors. We have been talking about China becoming relatively attractive and things like that, but that's a very small part of it. I think the fact remains that the mother market, which is the US market, has been providing fantastic returns, and a lot of money is going back to US, with Donald Trump coming back as president, and US economy getting preeminence in the thinking of the political class in US. I think money will also move back. A lot of money more move back to US from multiple geographies across the world, and that includes India. So we have to brace for that. The second factor is, unfortunately, we are also going through a bit of a slowdown, as you have been already pointing out, and the economists on the panel as well as experts have been pointing out that I think the Q2 wasn't good. Corporate results was also not good. And we are not expecting any great Q3 numbers as well as things stand now. So under the circumstances, the valuation at which Indian market was looking a bit stretched, and bit of correction has happened. Some bit of correction may still happen going forward. So we have to be a little realistic about the market expectation in the next calendar year. I'm not saying it's all gloom and doom. I think, as you rightly pointed out, interest rates in the economy are going to come down, and that should give it growth a fillip. We also have a lot of capital expenditure which is planned by the government, and private sector also is joining. So that's also good. And finally, I would say is that corporate India has learned their lessons from earlier slowdowns, and a lot of belt tightening has happened. I expect Q4 onwards, corporate India also should start producing better results. Now, all this should add towards a positive bias in the market going forward, but it has to be a stock picker's market, and we have to remember that.
But a double-digit return, would you expect that, or should one rule that out?
Well, double-digit return is definitely possible because we are expecting an EPS growth which is in double-digit. So return should be double-digit. But I would say is that one has to be extremely stock-specific in this matter as well.
Sure. Okay, Sugandha, let me come to you. Your sector really outperformed this year, 2024. Gold and silver outshone all the other asset classes. 27% returns for gold this time around as well. Tell us, what is the outlook? Should one actually go all in? Probably the large part of portfolio should be allocated towards gold and silver even in 2025. What's your expectation?
Hi Sakshi, thanks for having me on your show, and season's greeting to you, my co-panelists and all the viewers. So talking about gold can flaunt returns of around 27% in international markets this year and around 21% at the domestic market. A lot of factors have contributed to this massive run that we have seen in gold prices, be it the robust central bank buying, the easing by major banks, especially Fed, which has started its rate cut cycle in September and has gone actually very aggressive and have almost cut by 100 basis points. So these have been the two major catalysts. Apart from that, geopolitical tensions have driven gold prices to record highs this year of around 27.90 per ounce and around 80,000 mark in the domestic market. This trend is likely to continue in 2025 as well because there is a lot of uncertainty after Trump assumes office on 20th of January. There are a lot of concerns about fiscal uncertainty as well as the tariffs being imposed on Chinese goods. Alongside this, geopolitical worries are likely to continue in 2025, and central banks which have been diversifying their reserves away from dollar, this buying is likely to continue in 2025 as well. So in 2024 till quarter 3, central banks have already loaded up on around 694 tons of gold. They are actually moving away from dependency on dollar. This is likely to continue in 2025 as well. So a lot of factors are contributing, but yes, we have seen some pullback of sort in this current quarter, majorly driven by the strength that we have seen in dollar index after Trump's win in the US presidential elections. So this could be a slight dampener. So we cannot expect similar returns that we have seen in 2024, but yes, gold is likely to remain in demand in 2025 as well, and we are expecting returns of around 10 to 12% in 2025. So yes, talking about your question, gold should certainly form a part of everyone's portfolio, as it acts as a hedge against the depreciation that we are seeing in fiat currencies. A lot of volatility surrounding the geopolitical risk. So one should certainly allocate 10 to 15% of their portfolio towards gold in 2025 as well.
Right. So Sugandha, simplified for our viewers on India Today. For gold and for silver in Indian rupees, what is the level that you're watching out for towards the end of 2025 then?
In terms of the levels that we are looking at, on the downside, gold prices are likely to remain supported by 68,000 mark. And on the higher side, we are looking at levels of around 84,000 for 2025. Overall demand for silver in industrial applications has been rising significantly, especially the solar panel sector, industrial applications like electronics and electric vehicles. So this is likely to keep silver also in demand. And this year prices have been able to break this ceiling of $30 per ounce. So this is likely to work very well for silver prices in 2025 as well. Overall, we expect silver prices to test levels of around $40 first and then $42 per ounce as well in international markets. In terms of the domestic market, we have a near-term resistance at 1 lakh mark. Once that is surpassed, we are looking at first levels of around 1,10,000 and then 1,25,000 mark is also a possibility at the domestic market.
All the economists are also looking out for how Donald Trump's 2.0 and tariff talk will impact Indian economy. Even before we've actually seen Donald Trump take office, there's already a lot of hullabaloo happening around which are the countries that are going to be on his top radar. It's not India that surfaced so far, but what could be the likelihood that India will also face the brunt of tariff talk? Aditi.
Firstly, we'll have to see whether tariffs are imposed across the board or are they imposed on specific countries, and I think that is going to be the key for us, in terms of understanding what could be the impact on our exports to the US. Now, my sense is that obviously we will have heightened uncertainty in the coming year. But if we take a broader look at the current account deficit, for instance, for the current year, we are looking at a current account deficit of 1.3% of GDP, which is building in this record high trade deficit that we got in the month of November on the back of the gold imports, which news reports are suggesting may actually need to be corrected to some extent. So I would say 1.3% of GDP is our outer limit for the current account deficit for FY25. For FY26, we have a couple of rules of thumb that we're working with. One is that service imports will outpace merchandise imports growth. And the second is that merchandise import growth will outpace merchandise export growth, because we do think that domestic demand is going to grow faster than global demand, and especially given all these tariff-related uncertainties that we're talking about. Having said that, as of now, we're looking at a current account deficit which is closer to 1% of GDP in our baseline scenario. So even if the tariff-related concerns upset it a little bit, we don't expect the current account deficit to exceed 1.5% of GDP in FY26, which is a really very manageable level. It's not a level which is going to cause a lot of concern.
Okay, got that. Coming to you, Sudeep, I think the big question that all investors really want to understand from you is where to put in their fresh funds in 2025.
Well, I think as far as sector is concerned, one sector is related to the tariffs. I understand that the tariffs are a reality, and Trump has been talking about day one the tariffs will come. And I'm reasonably confident it will be differentiated tariff. And, the differentiated tariff, to my mind, will benefit India, particularly India's textile exports in a big way, because significantly imposed China, Indian textile manufacturers, exporters will benefit in a big way. So that is one sector which can definitely be looked at for 2020. The other sector may be a bit contrarian, but I believe that IT will do well. Make USA great again has a implication of a lot of spending in US, and this will be led by financial services, manufacturing, and others in US. And some of the Indian top IT companies have a significant presence in US BFSI, US manufacturing, and to my mind, they will have a even further robust order book and excellent margins going forward. So as far as Indian IT, I think it's going to be a good year. Yes, they will have some visa-related challenges, but they have navigated that earlier during first Trump presidency, and they will, I'm sure, continue to do that going forward as well. So these are the two sectors which I'm particularly bullish because of what's going to happen in US. As far as sectors beyond sector specific stocks are concerned, I like insurance-related stocks. A lot of reforms have been proposed in insurance. One of them is, reducing bank insurance significantly. Now that benefits LIC disproportionately, because LIC's bank insurance percentage is very small. Others will be disadvantaged. LIC will gain out of this measure. The second measure which is being talked about is life insurance companies will be allowed to sell non-life products and vice versa. Now this again benefits LIC disproportionately, because the kind of network LIC has, tomorrow when this is permitted, they will, in a very short time, I understand, will become a large health insurance player and large general insurance player as well. So, probably we'll see LIC 2.0 emerging very soon as this regulation comes in. So LIC is one stock where I would, recommend investors to, invest now. The other stock which I like is, again, grossly undervalued to my mind today, is Reliance Industries. I think, value unlocking will happen. Initial discussions are on for an IPO of Reliance Jio. Reliance Retail, some other value unlocking measures I'm sure will come. The traditional O2C business hasn't been doing that great, but long-term contracts are being signed there, which will augur well for the business going forward.
Talk to us a little bit about what is your expectation on these big conglomerates. Will they continue to generate wealth for investors in 2025? Reliance you've already talked about. What about the Tata Group? What about Adani's, which have already been facing so much of trouble? Are these big conglomerates going to be at the forefront of creating wealth for investors in India?
I think there is already a talk of Tata Capital IPO coming in.
Yes.
And that is kind of mandated because of RBI wanting all tier 1 NBFCs to become listed, and Tata Capital comes in that. So they will have to do an IPO by September 25. So that will do some value unlocking for a lot of Tata companies which are large shareholders in Tata Capital. So I think that, one-time value unlocking will happen. Apart from that, I think a lot of these businesses have been producing fantastic results, and they will continue to do that. And if Indian market continues to chug along, I think Tata group of companies also will continue to do well. I'm not picking any specific stock here, but I'm generally, I think the group will do well.
What about the Adani Group?
Adani, I think, it's an extremely volatile segment, Adani Group stocks, and we know a lot of news flows come in which destabilize investor confidence. Then again, confidence comes back. Then again, some more news flow comes. So it's a very, very volatile, pocket of the market. But certain Adani stocks we have been remaining positive, and we will continue to recommend. One is Adani Port, fantastic company, great potential, and every dip is an opportunity to buy. Both the cement companies, ACC, Ambuja, looks good. There is some consolidation happening with the smaller companies with Ambuja, and later on some more consolidation may happen, but this provides great opportunity for investors. The last one amongst the Adani companies, Adani Wilmar. I think the group is very keen on exiting this business, and once the exit happens, I understand value unlocking will happen. Some large conglomerate may buy it, or some large entity may buy it. So there is a value unlocking one-time opportunity in Adani Wilmar, so that also can be looked at.
Okay, understood. Coming back to Sugandha now, as far as some of the key points that have been raised by Aditi also on the currency factor, she's already expected some more weakening to happen. Tell us, as somebody who's been tracking the currency movements day in, day out, what is your expectation there? And the second factor will be oil. Because of the uncertainties around the globe continuing to be an overhang, what is your expectation on crude oil levels as well, Sugandha?
So, Sakshi, talking about rupee has largely been very stabilized. We have seen a lot of consolidation in rupee till the third quarter of this calendar year. But then in the fourth quarter, we have seen a sharp depreciation, and till date, rupee is down by around 2.5%.
Yeah.
So, RBI has been managing the volatility in rupee. And in fact, it is majorly because of the recent jump that we have seen in dollar index, wherein in this current quarter, dollar index has risen by more than 7%. So, this depreciation that we have seen in Indian rupee can largely be attributed to this fact also. Apart from that, the inflows have been quite sluggish. In fact, we have seen a trend reversal of sort in the current quarter where we have seen outflows from equity as well as debt market to the tune of around $10.3 billion this quarter. So reversing inflows of $20 billion till the previous quarter. So this is kind of acting as a dampener for the Indian rupee, and I see this depreciation to continue next year also on the back of the recent resurgence that we have seen in dollar index. Also, our forex reserves have declined to a 6-month low. So this depreciation is likely to continue at least in the first quarter of next year, where I see rupee heading lower towards level of around 86.5 to 86.8 mark. So considering both of these factors, rupee weakness is likely to continue, considering the strength in dollar index, and crude oil prices are also likely to act as a headwind for Indian rupee.
Okay, Aditi, coming to you on the weakening rupee, further adding pressure on the imported inflation, that's also likely to make the task for RBI yet again more difficult to tackle the rate cut journey. What is your expectation on the RBI rate cut front?
Our sense is that the CPI inflation could moderate to about 4.2% on average next year from 4.8% in FY25. And hopefully that should open up room for 50 basis points of rate cuts from the MPC, which could be spread between February and April or April and June. If we don't get this step down in the CPI inflation in the December print, then perhaps we need to wait for 2 rate cuts in April and then in June.
Okay, got that. In fact, we also spoke to State Bank of India chairperson Ms. Shetty on whether high inflation and the current weakening of the rupee will further add on to the pressure as far as the RBI rate cut trajectory is concerned. Let's quickly listen into what he had to say.
I think this demand for rate cut has been there for quite some time. But I think RBI and the MPC definitely are weighing the inflationary situation. Particularly on the food inflation side. Once it slightly moderates, I think they will be able to take a call on that.
Aditi, I'm coming back to you. You know, one of the points that Sujeeb had alluded to in one of his earlier answers was the factor that private capex has still not picked up. I wanted to ask you on that front. Do you think that will be the final spoke in the wheel that the economy really needs, that to start rolling? Is that expected to pick up pace at all? What is it that is stopping private capex from taking place right now?
So, our sense is that private capex is happening, but it's happening at a modest pace, which may be more sustainable and realistic. We're not expecting very loud or very exuberant private capex to take off given the overall scheme of things. 50 basis points rate cuts will be nice, but it may not really be a game changer. We have to look at all the other drivers for growth. Domestic consumption is likely to remain uneven, although we expect there to be some improvement in that. And when we look at the export situation with the kind of heightened uncertainty that lies ahead of us, I think it's going to lead to a little caution, and we really don't expect the private capex sort of narrative to change very dramatically now, especially until there is some clarity on what to be expected on the export side.
Many thanks to you, Sugandha. Many thanks, Aditi and Sudeep, for being with us on this very special edition. We will wrap it up on that note. Here's wishing all of you, our viewers as well, a very happy upcoming New